At the end of last month, CBRE released their semi-annual cap rates and pricing in commercial real estate report, which always gives a helpful glimpse into what's going on in the real estate market and investor outlook on the sector for the next 12 to 24 months. We are definitely in some uncharted waters right now, really as a result of all the uncertainty and change that started in the spring of 2020, and this change has created some massive shifts in commercial real estate during this time, many of which are shown very clearly by the data in this report. So to help you sort through what can sometimes feel like an overwhelming amount of data to soak in this video, I wanted to share the two most meaningful conclusions I came away with after reading this report and what these things might mean for the entire commercial real estate market throughout the rest of this year and into 2022. So the cap rate is one of the most commonly thrown around metrics in commercial real estate conversations between investors, brokers, and lenders, in large part because this metric is so easy to track. Cap rates just measure the net operating income of a property as a percentage of that property's acquisition price and basically just takes a snapshot of the deal at the time the property trades hands and looks at the going-in yield the investor can expect before any debt service or capital costs are factored into the equation. In general, investors are going to be willing to accept a lower going-in unlevered yield on their investment if they believe the income the property will generate is going to increase substantially over time, meaning that an investor that buys a property on the low end of a cap rate range is most likely pricing in significant rent and value growth during their ownership period. And on the other side of the spectrum, investors will generally look for higher going-in unlevered yields on their investment if they don't see that income and the value of the property rising over time, meaning that higher cap rates on real estate deals usually indicate that the market doesn't see much rent or value growth occurring in the foreseeable future. And as a result of this, seeing what cap rates on recent transactions look like in different geographic markets and product types can tell a really insightful story about where investors are projecting values to go in the future and what that might mean for specific cities and asset classes as a result. So with all that being said, let's zoom in on CBRE's most recent cap rate survey and talk through the two biggest themes I took away from the data and what the potential impacts on real estate professionals and investors might be going forward. So first, the biggest thing that stood out to me right away in the report is that the industrial asset class is absolutely on fire right now, and almost every other product type pales in comparison. With the surge in e-commerce demand we've seen over the last year and a half, demand for warehouse and distribution space has become the strongest it's ever been, and the numbers in this report show just how hot this sector has become. For both stabilized and value-add acquisitions, industrial cap rates decreased from H2 2019 baseline figures in every single market tracked for the 31 markets included in the report, and the average cap rate decrease during this time was almost 80 basis points. And even though this might not seem like much on the surface, to put this into perspective, for a deal trading at a 5% cap rate generating $1 million per year in net operating income, an 80 basis point drop in cap rates would result in a value increase of over 19% or over $3.8 million in this case, even before factoring in any operating income increases during this time. There were also many industrial markets that actually came in significantly above this number, with markets like Atlanta, Austin, Raleigh-Durham, Tampa, Boston, and Philadelphia all seeing cap rates compress by over 125 basis points in the last 18 months, and rents have grown in these markets by a significant margin, even double-digit year-over-year growth in some of these metros. Many highly populated US markets saw cap rates in the first half of the year starting in the twos, with metros like Northern New Jersey, the Inland Empire, Los Angeles, Oakland, Orange County, San Francisco, and San Jose all seeing cap rate ranges starting as low as 2.8%. More than half of survey respondents in the report were also willing to bid above asking price for industrial assets specifically, and multifamily was the only other product type on the list coming even remotely close to that figure, clocking in at 34%, while only 0 to 4% of those surveyed were willing to pay an above asking price for office, retail, or hospitality deals. And with cap rates compressing to record lows and bidding wars becoming the norm for industrial assets, based on what we talked about earlier on in this video, this is a huge indicator that industrial investors are pricing in significant rent growth projections into their underwriting, especially in heavily populated areas with limited raw land to develop. A 2.8 cap rate deal only makes sense if that 2.8% unlevered yield is projected to change a lot in the future, and if high single-digit rent growth forecasts don't actually play out in practice, this is where industrial investors might run into trouble. Just one down year of rents early on in your hold period can have a devastating impact on returns. So as industrial cap rates continue to drop in many metros across the country, the danger of oversupply becomes more and more real and is definitely something to keep an eye on in the industrial space, especially at a time where it feels like you just can't lose in this asset class. And speaking of oversupply, the other big takeaway I had when reading through this report was that for the second hottest product type in the country, multifamily, some of the hardest hit metros during the Great Recession back in 2008 have also become some of the most expensive markets to buy in throughout the entire country today. When looking at cap rate data, some of the most cyclical real estate markets throughout history also have some of the lowest cap rate figures we're seeing in today's market, with Phoenix, Las Vegas, Dallas, and Atlanta all falling into that category. Dallas clocked in with the lowest cap rate range of all infill markets tracked in the report at 3.0% to 3.75%, while infill deals in Atlanta and Phoenix traded at cap rates between 3.25% and 3.75% in the first half of the year. And for suburban properties, these cyclical markets top the charts again, with Phoenix seeing cap rates between 3.0 and 3.75%, Las Vegas seeing cap rates between 3.75% and 4%, and Atlanta and Dallas seeing cap rates in the market between 3.75% and 4.25%. And to put this into perspective, according to Real Capital Analytics and Newmark Research, non-major markets, so the markets aside from Boston, Chicago, LA, New York, San Francisco, and DC, saw cap rates bottom out during the last market peak in 2006 and 2007 at just 6.25% at their lowest. And this means that in today's market, even if NOI values stayed the same for the last 14 years, which they obviously haven't, multifamily values in many markets would have more than doubled just due to investor demand and willingness to accept a lower yield. However, what's different this time around is that in the last cycle, major markets were believed to have higher long-term growth potential, which caused cap rates in these markets to run about 100 to 125 basis points lower than for secondary markets during this time, with cap rates at the peak for major metros at around 5.25%. However, this time around, the trend looks to almost be reversed, with investors pricing in massive spikes in multifamily rents in secondary cyclical markets, which is very clearly shown in the data. For suburban assets, Phoenix and Las Vegas are seeing lower cap rates than markets like Los Angeles, Seattle, Miami, Chicago, Washington, D.C., and even New York City. And although many of these secondary markets are seeing strong job and population growth numbers, these markets also have some of the most available raw land for development in the entire country, and as a result, this could be a major risk for investors in many of these metros. To cite CBRE's most recent national multifamily report, in cities like Austin, Fort Worth, Orlando, Charlotte, and Nashville, new product deliveries made up over 3.5% of existing inventory in the second quarter of this year, and with cap rates in several of these markets hovering in the low 3% range, this could spell trouble for investors if rent growth projections are overly aggressive to get to these types of valuations. Ultimately, this is all to say that the market is hotter right now than I have ever seen it, specifically in industrial and multifamily, and with bonds paying next to nothing right now and real estate delivering bond-like cash flows as an investment vehicle, it's easy to see why so much capital has flooded into the real estate space over the last decade and why cap rates have become so compressed in these two product types. However, even if the fundamentals are there right now in many metros across the country, with more than 75% of the respondents to the CBRE survey seeing an increased appetite for investor risk and primary markets falling out of favor and being replaced by secondary, historically cyclical markets, it's hard to see how this pace can continue indefinitely, and these are the times where investors need to be the most careful. Pricing in major rent and value growth increases can help you win deals in this type of an environment, but real estate is a cyclical business and supply can get out of hand really quickly, leading to slowed growth or even rent decreases, which can turn your home run deal into really a strikeout very, very quickly. So I hope this was helpful in getting a sense for where the commercial real estate markets are right now. And if you're looking to learn more about how to analyze specific commercial real estate deals, or you're looking to break into the industry and land a job at a top real estate investment, development, or brokerage firm, as always, make sure to check out our all-in-one membership training platform, Breaking a CRE Academy. A membership to the Academy will give you instant access to over 120 hours of video training on real estate financial modeling and analysis. You'll get access to hundreds of practice Excel interview exam questions, sample acquisition case studies, our entire library of pre-built acquisition, development, and waterfall models for multifamily, office, retail, and industrial properties. And you'll also have access to private one-on-one email-based career coaching if you're looking to break into a top real estate private equity, brokerage, or lending shop and want some additional personalized feedback on your own unique career scenario. And if you like this video and want to see more content on this channel on the state of the real estate market, make sure to hit the like button to let me know, and let me know in the comments where you see industrial and multifamily going from here, and if you see office, retail, or hospitality making any sort of a comeback in the near future. As always, thanks so much for watching, guys. I hope you found this helpful. Subscribe to the channel if you haven't already to see more videos like this every single week, and I'll see you in the next video.